the use of investment company rankings in retail communications. A ranking entity is defined as any entity that provides general information about investment companies to the public that is independent of the investment company and its affiliates, and whose services are not procured by the investment company to assign the investment company a ranking. So Morningstar, Lipper, there's different ranking entities. S&P, they do rankings of mutual fund companies. The mutual fund company can't pay them for a ranking. That would be prohibited. Member firms may not use investment company rankings in an advertisement or item of sales literature other than rankings created and published by a ranking entity or rankings created by an investment company that are based upon the performance measurements of a ranking entity. So if they want to use what their rank is, it has to be created by the ranking entity, not created by the investment company themselves, or created using the same methodology that the ranking company would use. Investment company rankings must comply with the following requirements. A headline or other prominent statement must not state or imply that an investment company or investment company family is the best performer in a category unless it is actually ranked first in the category. It actually must be number one to say it's number one. All advertisements and sales literature concerning an investment company ranking must prominently disclose the name of the category, growth funds, the number of investment companies in the category, the name of the ranking entity, and, if applicable, the fact that the investment company created the category, the length of the ranking period and its ending date, the criteria on which the ranking is based. Is it based upon total return, risk-adjusted performance? There's lots of different criteria on which rankings can be based, different classes of shares even. All advertisements and sales literature containing investment company rankings must also disclose the fact that past performance is no guarantee of future results. So what commonly happens is people, when they look to purchase a mutual fund, want the number one ranking fund. Common. That doesn't mean it's going to be number one in the future. That's all that is trying to remind people of. For investment companies that assess front-end sales loads, whether the ranking takes those loads into account. That would be something that the client should understand. The publisher of the ranking data, if it was read in a magazine, you have to cite your source. If the ranking consists of a symbol, like some sort of a star system, rather than a number, the meaning of the symbol. So maybe a 4-star ranking indicates that the fund is in the top 25% of all funds. You have to explain what the 4 stars means. 4 stars might sound like it's number one, but it might not mean that. So that must be disclosed. Any investment company ranking included in an item of sales literature must be, at a minimum, current to the most recent calendar quarter ended prior to use. Any investment company ranking included in an advertisement must be current to the most recent calendar quarter ended prior to the submission for publication. So whether or not it's sales literature or an advertisement, it doesn't really matter. The ranking listed must be current to the most recent calendar quarter. Except for money market funds, advertisements and sales literature may not present any ranking that covers a period of less than a year, unless the ranking is based on yield. So if it's a money market fund, less than a year, then that's perfectly allowable. But if it's not a money market fund, it may not present any ranking that covers a period of less than 1 year. An investment company ranking based on total return must be accompanied by rankings based upon total return for a 1-year period for investment companies in existence for at least 1 year, 1 year and 5-year periods for investment companies in existence for at least 5 years, and 1, 5, and 10-year periods for investment companies in existence for at least 10 years, supplied by the same ranking entity relating to the same investment category and based upon the same time period. So if the ranking is based on total return, for sure you want to know this. Ranking based on total return. Total return takes into account distributions and growth. If the fund has been around for 1 year, well then it must include 1 year. If the fund's been around for 5 years, then it must include 1 year and 5 years. If the fund has been around for 10 years or longer, then it must include 1 year, 5 year, and 10 year total return performance data. 1, 5, and 10 year for sure on the test. An investment company ranking based upon yield may be based only on the current SEC standardized yield calculation and must be accompanied by total return rankings for the time periods specified above. So the same rule of this. If the fund's been around for a year, 5 years, 1 and 5, 10 years plus 1, 5, and 10 years. So if they use current yield, they must also accompany it with total return. The choice of category, including a subcategory of a broader category on which the investment company ranking is based, must be one that provides a sound basis for evaluating the performance of the investment company. So it must be properly categorized, is basically what that's saying. Advertisements or sales literature must not use any category or subcategory that is based upon the asset size of an investment company or investment company family, whether or not it has been created by a ranking entity. So it doesn't matter how big the fund is. That's what this is saying. It can't be based upon size. Investment company rankings for more than one class of investment company with the same portfolio, multiple class or two-tier funds, must be accompanied by prominent disclosure of the fact that the classes have a common portfolio and the fact that the classes have different expense structures. So it's really common within the mutual fund. There's Class A shares, Class B shares, Class C shares, there's institutional classes of shares, and they have different expense ratios, they have different sales charges, thus they're ranked differently. So those requirements must be met. Common portfolio, different expense structures. No advertisement or sales literature for an individual investment company may provide a ranking of an investment company family, so 2 or more investment companies that hold themselves out as related companies, unless it also prominently discloses the various rankings of the individual investment companies supplied by the same ranking entity. So if you've got a family that includes 2 or more different companies, basically, you can't just advertise based upon the family. You have to also disclose the rankings of the individual companies within the family, is what that means. So very specific rules when advertisements are prepared, so sales, literature, advertisements. Today, we use this broad category of communications, but the way this FINRA rule is written, it still does reference the terms sales, literature, and advertisements. So specific rules for the use of rankings. FINRA Rule 2213 has requirements for the use of bond mutual fund volatility ratings. This term, bond mutual fund volatility rating, is a description issued by an independent third party relating to the sensitivity of the net asset value of a portfolio of an open-end management investment company that invests in debt securities to changes in market conditions and the general economy, and is based on an evaluation of objective factors, including the credit quality of the fund's investment portfolio holdings, the market price volatility of the portfolio, the fund's performance, and specific risks such as interest rate risk, prepayment risk, and currency risk. So a bond mutual fund volatility rating. Very specific rules if a member or an associated person of a member wants to use the volatility rating. The rating cannot identify or describe volatility as a risk rating. So there's this idea of volatility, how variance from the mean, what is the range of past returns, how likely is, see, the whole problem is we can't use the past to predict the future. So when we look at volatility, it's telling us the history, right? The history of the bond portfolio. You can't make it as simple to the client as this is a measure of risk. You can't make it that simple. So you can't describe volatility as a risk rating. Even though we kind of internally do look at it that way, you can't say it out loud to your client. The supplemental sales literature incorporates the most recently available ratings, if you're going to use bond mutual fund volatility ratings, most recent, and reflects information that at a minimum is current to the most recently completed calendar quarter ended prior to use. So that's the same for volatility ratings of bond portfolios, same for ranking entity ratings. So this idea, if you remember back to the discussion of the portfolio, in the portfolio we had bonds, and the longer term to maturity of a bond, the more interest rate sensitive it is, the market price of the bond, we call that concept duration. So it's kind of looking at how price sensitive is the portfolio, volatility. The criteria and methodology used to determine the rating must be based exclusively on objective, quantifiable factors. The rating and the disclosure statement that accompanies the rating must be clear, concise, and understandable. The entity that issued the rating provides detailed disclosures on its rating methodology to investors through a toll-free telephone number, a website, or both. So whenever you make communications based upon these volatility ratings, the customer must know how to get additional information about exactly what the heck this is all about. It's objective, not subjective. Communications containing a bond mutual fund volatility rating shall include a disclosure statement including all of the information required by this rule. The disclosure statement may also include any additional information that the firm believes is relevant to an investor's understanding of the rating. Communications containing a bond mutual fund volatility rating shall contain all current bond mutual fund volatility ratings that have been issued with respect to the fund. Information concerning multiple ratings may be combined in the disclosure statement, provided that the applicability of the information to each rating is clear. So what does the disclosure statement have to include? Anytime sales literature or advertisement, these communications use bond mutual fund volatility ratings. So within the text of the disclosure statement, the following disclosures must be provided: the name of the entity that issued the rating, the most current rating and date of the current rating, with an explanation of the reason for any change in the current rating from the most recent prior rating, a description of the rating in narrative form containing the following disclosures: a statement that there is no standard method for assigning ratings, a description of the criteria and methodologies used to determine the rating, a statement that not all bond funds have volatility ratings, whether consideration was paid in connection with the obtaining the issuance of the rating. That must be disclosed. A description of the types of risks the rating measures, for example, short-term versus long-term volatility. A statement that the portfolio may have changed since the date of the rating. A statement that there is no guarantee that the fund will continue to have the same rating or perform in the future as rated. FINRA Rule 2214, requirements for the use of investment analysis tools. A firm that offers or intends to offer an investment analysis tool is required to, within 10 business days of first use, provide to FINRA's Advertising Regulation Department access to the tool. The firm must also file with the department any templates for written reports produced by the tool, Any retail communications concerning the tool must be filed within 10 business days of first use. So the use of investment analysis tools, that's a concurrent filing requirement within 10 business days of first use. FINRA Rule 2215 sets forth guidelines for communications with the public regarding security futures. Futures have higher risk than other investments that we might be recommending. So we have a prior to use filing rule. So if it has to do with security futures, firms are required to submit all retail communications concerning futures to FINRA at least 10 business days prior to first use. Firms are required to withhold the communication from publication or circulation until any changes specified by the Advertising Regulation Department have been made. A communication concerning security futures must be accompanied or preceded by the security risk disclosure document if it contains the name of specific securities. Communications that contain the historical performance of securities futures must disclose the relevant costs, which must be reflected in the performance. So due to the higher risk, any communications with the public regarding security futures must be filed at least 10 business days prior to first use. Communications with the public about CMOs, collateralized mortgage obligations. So a CMO refers to a multi-class debt instrument backed by pools of mortgage pass-through securities or mortgage loans, including real estate mortgage investment conduit remix as defined in the Tax Reform Act of 1986. All retail communications and correspondence concerning CMOs must include within the name of the product the term collateralized mortgage obligation. May not compare CMOs to any other investment vehicle, including a bank certificate of deposit. They're nothing like a bank certificate of deposit, so they may not compare the CMO to any other investment vehicle. Must disclose as applicable that a government agency backing applies only to the face value of the CMO and not to any premium paid. Must disclose that a CMO's yield and average life will fluctuate depending on the actual rate at which mortgage holders prepay the mortgages underlying the CMO and changes in current interest rates. Before the sale of a CMO to any person other than an institutional investor, a member must offer to the person educational material that includes the following: a discussion of the characteristics and risks of CMOs, including credit quality, prepayment rates and average lives, interest rates, including their effect on value and prepayment rates, tax considerations, minimum investments, transaction costs, and liquidity. There must be a discussion of the structure of a CMO, including the various types of tranches that may be issued and the rights and risks pertaining to each, including the fact that two CMOs with the same underlying collateral may be prepaid at different rates and may have different price volatility. The relationship between mortgage loans and mortgage securities must also be discussed. Questions that an investor should ask before investing must be included within the educational material and a glossary of terms. I think what happened is a lot of people historically in the past, 10 years have thought CMOs were safe, and they're really, really not, as you're well aware of. So there's this additional educational disclosures required under relatively new FINRA Rule 2216. Retail communication and correspondence that promote a specific security or contain yield information must conform to these requirements. So anytime it's a retail communication or correspondence that promotes a specific CMO or contains yield information about a CMO, it must conform to these requirements. If it's a radio or television advertisement regarding a CMO, granted you don't see those very often, the following oral disclaimer must precede any radio or television advertisement. The following is an advertisement for collateralized mortgage obligations. Contact your representative for information on CMOs and how they react to different market conditions. So that must be an oral disclosure to a radio or television ad. It must also contain the following disclosure if it's a radio or television ad. The yield and average life reflect prepayment assumptions that may or may not be met. Changes in payments may significantly affect yield and average life. So the first oral disclaimer must be at the beginning of the radio ad, and then the second one can be at the end. That's the only difference between those two. So any radio or television advertisement has to have, if it's regarding CMOs, which is very rare, maybe they're on at 3 in the morning when I'm asleep, I don't know, 2 oral disclosures, one in advance and one whenever they want to have it. So that includes our review of FINRA's communication rules. I know it's a lot. This is a lot. It's a really important section, and there is a lot of things to know, and I'm sorry I can't make it too much more exciting than it is. It's just not conceptual like some of the other chapters are, but it is really important for your test. So practice making some charts and some graphs for some of the numbers and the dates that we have to use for all of these rules in this section. FINRA Rule 3230 has to do with telemarketing, for sure going to be on your test. So the Telephone Consumer Protection Act of 1991, administered by the Federal Communications Commission. So they just ask the weirdest questions. Who administers the Telephone Consumer Protection Act? The FCC does. Enacted to protect consumers from unwanted telephone solicitations. I hate it when I get those. Put yourself on the do not call list, right? A telephone solicitation is defined as a telephone call initiated for the purpose of encouraging the purchase of or investment in property, goods, or services. The Act governs commercial calls made both to landlines and wireless devices, so your cell phone even, recorded solicitations from auto dialers, and solicitations and advertisements to fax machines and modems. So it does apply to faxes as well. The Act requires an organization that performs telemarketing to maintain a do not call list of customers who do not want to be called. So my mother-in-law, anytime the phone rings, she's always, don't answer it, oh my gosh, answer it. And if it is a solicitation, tell them, do not call me again. Granted, I'm pretty sure she's on the do not call list, so we'll see why and who might be calling her still. So it is possible you'll still get phone calls. I'll show you why. So this idea that anytime a firm does telemarketing, they must maintain a firm-specific do not call list. So if the person says, I'm not interested right now, you're going to say, okay, and what are you going to do? Call them tomorrow. If they say, do not call me ever again, what are you going to do? Add them to the do not call list. So once someone has requested to be on the firm's internal do not call list, they must be kept on the list indefinitely. So they're on there forever, basically. Members must honor a person's do not call request within a reasonable time from the date that they asked to be placed upon it. This period may not exceed 30 days. So on the list indefinitely, once they ask, they must be added to the list, within 30 days. So this fact that the firm's do not call list, it lasts forever, is in correspondence with the federal do not call list. Once you put your name on it, way back when, it used to be good for like 5 years at a time. That's not true anymore. It's on the list indefinitely. So I always have to go check every once in a while because I can't remember. Did I do that for my home phone? Oh yeah, I did. So you can always check. But once it's on either the federal or a firm do not call list, it is on that list forever, indefinitely. If such requests to be added to the do not call list are recorded or maintained by a party other than the member on whose behalf the telemarketing call is made, the member on whose behalf the telemarketing call is made will be liable for any failure to honor the do not call request. So sometimes firms will contract with telemarketing firms to make the phone calls. If the telemarketing firm doesn't follow this rule, the member firm will be held liable for not following this rule. Members must ensure that anyone making cold calls for the firm informs customers, this is important, of the firm's name, telephone number, and address. So that's something that must be verbally disclosed, name, telephone number, and address. Firms must promptly identify themselves via caller ID, transmitting the telephone number, and when available by the telephone carrier, the name of the member firm. So it can't say undisclosed. You know, sometimes you get those calls and you look at it and it doesn't have anything listed. You can't do that. You have to say what brokerage firm is making the telemarketing call. Member firms are prohibited from blocking the transmission of caller ID information. The time of day restriction states that telemarketing calls may be made between 8 a.m. and 9 p.m. local time at the called person's location. So when can you call? So this is for sure on the test. 8 a.m. to 9 p.m. at the called person's location, not where the phone call originates from. So could you participate in a 24-hour cold calling marathon? No. Firms must follow their own firm-specific do not call list as well as the national do not call list. Member firms must access the updated national do not call list at minimum every 31 days. So firm-specific do not call list. And then they also must use the national list. Update, I would know this, every 31 days. Update 31 days. So we've got a couple of numbers here. Client doesn't want to be called. They need to be added to the firm list within 30 days. They stay on both the national list and the firm-specific list indefinitely. The firm must check, because people are constantly adding their name to the national do not call list. Now, I told you the time period restriction. I said that's always a question, 8 a.m. to 9 p.m. The time of day restriction pertains to making a telemarketing call. So if the person that is being called is a person with whom the firm has an established business relationship, you can call them whenever you want. I'm not saying call them at 10 p.m. It's just that the time period restriction only applies to telemarketing calls. And if the firm has a relationship with the person that is being called, then the time period restriction does not apply. The time period restriction does not apply if you're calling a broker-dealer, or if the member has received the person's prior written express invitation or permission. Then the time period of which you can call. So you could call them at 7:30 if they told you to call them at 7:30 is basically what this is saying. This act exempts, so the Telephone Consumer Protection Act does not apply to calls made to parties with whom the caller has an established business relationship or where the caller has prior permission. So you can call someone that is a customer of the firm, even if they're on the federal do not call list. And you can call them whenever you want. Not recommending calling them at 10 o'clock, but you could. Calls made on behalf of tax-exempt nonprofit organizations are not subject to this act, and calls made for legitimate debt collection purposes are also not subject to this act. So you know who's calling my mother-in-law? People with whom she has an established business relationship. So that happens, and a lot of tax-exempt nonprofits call her too because she makes a lot of donations. So those people are not governed under this act. So we need to know how, if somebody said, please call me about your firm's services. How long is that authorization good for? Because it's highly possible the person is on either the firm's internal do not call list or is on the national do not call list. So the Act allows a member to call a person if that person has contacted the member to inquire about an offer or service offered by the member within the previous 3 months immediately preceding the date of the telemarketing call. So if they've asked to be called, you need to call them within 3 months, basically is what that's saying. So long as they have asked to be called within the previous 3 months, then the Act does not apply anymore. You can call them even if they're on the do not call list. So there is sometimes funny questions that, when can you call your existing customers? Whenever you want. That's true, whenever you want. Sales activity. So we have questions about sales presentations and the use of sales tools, approved sales material, fair and balanced comparisons, predictions and projections, if I can talk, disclosure of risks, and required disclosures. So we just spent a significant amount of time on FINRA rules. We started this section with a little bit on the Securities Act of 1933, then we did a whole lot on FINRA rules. We're going back now, based upon the outline, of course, written by FINRA to prepare you for this test, to the Securities Act of 1933. So Section 5 of the Act. Prohibitions relating to interstate commerce and the mails. Unless a registration statement is in effect as to a security, it is unlawful for any person, directly or indirectly, to make use of any means or instruments of transportation or communication in interstate commerce or of the mails to sell such a security through the use or medium of any prospectus or otherwise. You can't offer to sell a security across state lines unless there is a registration statement in effect. It's also unlawful for any person, directly or indirectly, to carry or cause to be carried through the mail or in interstate commerce by any means or instrument of transportation any such security for the purpose of sale or for delivery. You can't put the security in the mail if the registration statement has not been cleared for sale by the SEC. This is all under the Paper Act, of course, the Act of 33. It shall be unlawful for any person, directly or indirectly, to make use of any means or instruments of transportation or communication in interstate commerce or of the mails to carry or transmit any prospectus relating to any security with respect to which a registration statement has been filed under this title, unless such prospectus meets the requirements of the Act. So you can't just make up your own prospectus. The prospectus has to include certain specific information required under the Securities Act of 1933. You would not want to carry or cause to be carried through the mails or in interstate commerce any such security for the purpose of sale or for delivery after sale, unless accompanied or preceded by a prospectus. Whenever you sell a new issue, you must give out a prospectus. You can't send the security for delivery unless the client has already received a prospectus. So that kind of just builds on what we've talked about before. It shall be unlawful for any person, directly or indirectly, to make use of any means or instrument of transportation or communication in interstate commerce or of the mails to offer or to sell or offer to buy through the use or medium of any prospectus or otherwise any security unless a registration statement has been filed. Section 5 of the Securities Act of 1933 allows an emerging growth company or any person authorized to act on behalf of an emerging growth company to engage in oral or written communications with potential investors that are qualified institutional buyers or institutions that are accredited investors, either prior to or following the date of filing of a registration statement. So this is a very specific rule under the Securities Act of 1933. They use the term emerging growth company. So the newest rule that we have that's not quite taken effect is called the Jobs Act, as far as the ability to solicit the purchase of a security without having the filing done of a registration statement. So this allows it. It just says it is okay. Oral or written communication with potential investors. Very specific here though. Qualified institutional buyers or institutions that are accredited investors. Eventually, someday, we'll see the Jobs Act is going to significantly expand that rule.